The answer to most problems in trading is fair value gaps. Now, to understand why fair value gaps are superior, we need to first go over 3 mistakes that people make when using fair value gaps. Where the first mistake is assuming that every fair value gap will hold. And how can we know when a fair value gap actually wants to hold? There's 3 components that we need to go over right there. Where if we want to know if a fair value gap will hold, we need to know about context, we need to know about the institutional story, and we need to know about seek and destroy. First things first is context. Context is understanding the time frames. So the time frames I'm using is the monthly, the weekly, the daily, 4 hour, 1 hour, 50 minute, 5 minute, and 1 minute. The higher the time frame, and the highest time frame I use is the monthly time frame, that is going to have the stronger fair value gaps. Now, why is understanding those time frames important? Because oftentimes people like to jump into the 15-minute time frame and automatically trade off of every fair value gap that they see. Well, this fair value gap right here is on the 4-hour time frame. Then we will see there are a lot of 5-minute fair value gaps higher already. So why are we not continuing off of those fair value gaps, and why are those fair value gaps not actually holding? And the definition of when a fair value gap is actually holding is when a fair value gap is getting traded back into and it creates a new fair value gap off of that. So for example, this 5-minute fair value gap right there is holding right there, the bearish fair value gap, because it creates a new 5-minute fair value gap lower off of that. That is then the definition of holding for me. But why do all these bullish fair value gaps right there not hold? Well, because context. There is a 4-hour fair value gap just below all those 5-minute fair value gaps. So those bullish 5-minute fair value gaps, they are not in context of that 4-hour fair value gap going higher. This is exactly the reason why the higher time frame is important. Not because you can't go into the 5-minute and simply trade that. You can, but you need to have an understanding of what the higher time frame is doing, because those fair value gaps have a stronger magnet. So the pull towards that fair value gap is stronger, and they also have a stronger rocket. So the moving away from that fair value gap is also stronger, because banks, institutions, they do not operate from a 5-minute time frame standpoint. They operate from the higher time frame. So the higher the time frame the fair value gap is on, the stronger that fair value gap. So make sure when you are using the time frames correctly that every single time frame, every fair value gap on that time frame is in context of the time frame above it. And why is then this 4-hour fair value gap in context? That is because this 4-hour fair value gap right there, there is no daily fair value gap directly below it right there. There is no daily fair value gap that it can sting into right here, which we can see on the daily right there, the gray box being the 4-hour fair value gap. There is no daily fair value gap. And for the daily, there is also no weekly fair value gap. And for the monthly, we are already inside that monthly fair value gap. So then when we work our way down, every single time frame right here is in context of the time frame above it, which is the first step to understanding why a fair value gap will hold or will not hold. Then the second step is an institutional story, because right here at this moment in time, this bearish fair value gap right there is also in context, meaning there is no daily fair value gap above it right there. There's no weekly fair value gap right above it. So why does that 4-hour fair value gap not hold? The institutional story is the following. The market does one of two things. It is either offering fair value or it's seeking liquidity, where offering fair value is again seen through the 3-swing movement. So we have one swing lower, swing high right there, which first swing is sell side. We offer sell side in the market. We offer sellers a fair chance to get involved. Then after, we offer buyers now a fair chance to get involved, because this swing lower, the first swing, we only had sellers getting involved. We only gave a fair chance to sellers. So now we need to offer buyers a fair chance as well. So right here, we offer buyers a fair chance right there as well. Then we move lower again, creating 1, 2, 3, where this area where we now have sellers and buyers overlapping right there. So 2 swings overlapping, that creates a fair value area. So if we want to retrace, then the only area where we have not offered fair value just yet is indeed below that low right there. And this is the only sell side area where we don't have buy side overlapping just yet. So a retracement can be expected towards that fair value area to then continue lower, because that again creates this new fair value area to offer fair value, to offer both buyers and sellers a fair chance to get involved. Now, what does that look like in the chart? Well, right here, if we move lower, we have one swing, we have two swings right there. This is the sell side, the buy side right there. And then we offer the sell side again, which is ultimately below this low, the lowest low that we create right there, which then forms the following, because right now, this gray box right here then becomes the fair value area. So if we are offering fair value, we only need to retrace back towards these lows right there to then continue lower off of that. If we are not continuing lower after offering that fair value right there, then what is the market doing? Well, again, the market does either one of two things when it is moving. It's either offering fair value or seeking liquidity. So right there, we can say it's not offering fair value anymore, is it? So then what is it doing? It is seeking liquidity. Seeking liquidity, and what is liquidity again? Swing highs and swing lows. So then this right there becomes the target. So this bearish fair value gap right there, does that have a high probability of actually holding? Well, according to the institutional story, no, it does not. So then what actually happens? We see a bullish fair value gap being created right there after we take out this swing low, which as we know it also creates what? A sharp turn, bearish fair value gap and then a bullish fair value gap. Combined with the institutional story, what then is the higher probability fair value gap? This fair value gap sitting right there. Now this right here is all hindsight, but this was exactly called out before it happened in the money making team, and of course we made money from it as well. Now the last component to understanding if a fair value gap will most likely hold is understanding seek and destroy. Seek and destroy, also known as ranging conditions, consolidations. So we are not trending, we're not moving towards one side, we are staying in the same place. And seek and destroy conditions can be found through fair value gaps as well. General rule of thumb, if a bullish fair value gap does not hold and a bearish fair value gap also does not hold, that is seek and destroy conditions. So right here, we have this bullish fair value gap sitting right there. That one does not hold. What is again that holding? It does not create a new fair value gap higher off of that previous fair value gap. After that, we see this fair value gap right there, and even a little bit lower, this fair value gap. Both bearish fair value gaps also do not hold. They do not create new fair value gaps going lower on the same time frame that you are looking at. So after that, once that happens on both the bullish side and the bearish side, that leads to seek and destroy conditions. That is when, if you are a trending trader, which most people are, you would want to avoid every single fair value gap that comes after. So all the fair value gaps that we see going higher right there, they are all already low probability right there. Every fair value gap that is being created lower than the 4-hour time frame is also already lower probability. And lower probability as in it is most likely not going to follow through higher or lower just yet and return into those trending conditions. So then how do we know if a fair value gap is ready to hold again and it's not in seek and destroy conditions anymore? That is when we create a fair value gap, for example, this fair value gap right there, and we follow through on that with a new fair value gap. So the fair value gap holding is then again a sign that we are returning back to trending conditions. So if we, for example, would have come back towards this 4-hour value gap and we create a new 4-hour value gap lower off of that, that is then a great sign, a great indication that we are returning back to trending conditions. So the fair value gaps have again a high probability of holding. Now, the second mistake that people make when using fair value gaps is assuming that you need to use old fair value gaps. No, you don't need to, and I'm going to show you what I mean. So what exactly are old fair value gaps? Old fair value gaps are fair value gaps that already have been traded back into. So for example, this fair value gap right there gets traded into very early right there. The same for this fair value gap and the fair value gap that we see after right there. So as soon as a fair value gap is traded into, it becomes an old fair value gap, meaning you don't use it anymore. That old fair value gap is not relevant anymore. The only thing that's relevant is now this thing that they leave behind in that fair value gap, the story they tell you. So this old fair value gap right there, as soon as we create a new fair value gap right there, we can see that this old fair value gap is getting disrespected, meaning premium arrays, bearish fair value gaps are not holding. And whenever we have a bullish fair value gap right then going through an old fair value gap, that is higher probability of actually holding. And as soon as this one is getting disrespected, you can simply delete it. It's not going to give you any more accuracy. It's just a waste of chart space. And then for the target, if we look at the weekly time frame, for example, then on the weekly right here, we see this weekly fair value gap right there that has already been traded into. So when we target higher based on that 4-hour fair value gap and we expect higher prices, the target is not the weekly fair value gap anymore. It has already been traded back into. That is not the target. The target becomes this swing high right there, the liquidity point that is inside that fair value gap, inside that old fair value gap. Where this can still function normally because that fair value gap has not been traded back into. And if we even get more detailed about this, let's look at this old fair value gap right there. That old fair value gap is already, of course, as we know it with the first mistake, is not in context because we have a monthly fair value gap going against it right there. But even more on the weekly right here, we see this first candle coming into it. Tries to reject lower because that candle, and when it's wicking right there, it's a sign of respect that we might want to continue lower on the next candle. When we then do not follow through lower with that next candle and it's again an up candle, this fair value gap can already be removed. It's not valid anymore. It's not strong enough to push price lower. It's now an old fair value gap. Where eventually, once we come above this high, which is actually the target, then if we zoom in and we go into the daily time frame, then we see that same fair value gap again is not the target. The swing high is the target, but what else? This fair value gap has not been traded back into. So that can be used as a target instead. And that's exactly why we are seeing a huge rejection off of that fair value gap and not the old weekly fair value gap we had. And oftentimes this is a concept that is actually used in the SMC space where people mark out old fair value gaps and then use them as old support and resistance because it's now traded through. It defeats the purpose of why we even use these concepts in the first place. It's to get more accurate, it's to get a better accuracy. If we mark out every single old fair value gap, then this is nothing more than if I were to put a random line right there on my chart and I would say, oh, look at that resistance. Oh, wow, look at that exact support. See how the bodies are supporting that line? It's the exact same. So we lose all accuracy right there. The accuracy comes from the most recent fair value gaps that are being created in price action, which are the ones on the right side of our chart, the ones that have not been traded back into. Right there, we see this one gives us the accuracy that we need in order for us to take an entry. The third big mistake is that people assume fair value gaps are always pointing in the right direction. Now, if we think about what fair value gaps are, fair value gaps, they show the intention of price, where price actually wants to move towards. But that exact same concept can also be used against traders, because if it shows intention, it can also be used as then manipulation, fake intention. So what does that look like? Well, right here we have 4-hour bearish fair value gaps going lower right there. Some people would assume this 4-hour value gap might hold right there. We can already see it is not getting respected, it's not holding, and then leaves behind a new 4-hour fair value gap higher right there. Where the first one was actually used as manipulation. Now remember the seek and destroy conditions that we went over. Seek and destroy was again when we have no fair value gap holding on either side of the market. When we have a manipulation move like this, how do we know it is actually manipulation? Do you see one 4-hour fair value gap lower right there that actually held and that was holding, meaning it actually created a new 4-hour fair value gap lower right there? No. So we can say there was never established bearish order flow right there. So even though it might follow through, we still have to keep in our mind, hey, there was never a fair value gap that actually held. So when we then create a bullish fair value gap like that, that's the sign that we do still want to continue higher overall. Now inside this 4-hour fair value gap right there, we are running into the same problems constantly, the same mistakes that a lot of people make when using fair value gaps. Because you can see how these mistakes are also linked to each other. They go hand in hand. Where this 5 minute fair value gap, all right, that 5 minute fair value gap is actually holding, pushes price lower, continuing lower into a new 5 minute fair value gap. But is this 5 minute fair value gap in context right now? No. Why not? It's running into a 4-hour bullish fair value gap. Which one is stronger? The 4-hour fair value gap. So it's much more likely that the 4-hour fair value gap right there will actually push price higher instead of this 5 minute fair value gap pushing price lower. Already indicates this fair value gap is the one that will most likely hold. So then eventually when we start to create new 5 minute fair value gaps higher off of that 4-hour fair value gap, we can just simply say that these 5 minute fair value gaps are high probability. They're in context, the institutional story is supporting the idea overall, we don't have any seek and destroy conditions, and that fair value gap is actually pointing in the right direction because it's not a manipulation fair value gap like we talked about. So here on the 1 minute, we see this gray box right there, which is the 4-hour fair value gap. Then we have the 5 minute fair value gap higher right there. That can even be confirmed now on the 1 minute time frame. So at this moment in time, this in itself, the creation of that fair value gap is already an entry. Covering the lows, targeting a nice 1 to 2, targeting higher right there. That is absolutely perfect. That's a great trade. And maybe I'm a little biased because I also took this exact trade, and I'll show you a little live clip, which is currently playing right here of me taking that trade. And again, shared in the money making team as well. So we now understand the 3 common mistakes. That was the first thing we needed to understand in order to answer the question, why fair value gaps are superior. And the reason fair value gaps are superior for me is because every single movement in price relies on fair value gaps. So for example, a market structure shift needs a fair value gap. So then the market structure shift is not that relevant. The fair value gap is the most relevant. So the same applies right here, where you can enter even before you have a market structure shift, for example, in the sharp turn. For example, the 4-hour fair value gap that we are trading off of here on ES right there, and also on Australian dollar, US dollar right there. This is even before a market structure shift. And next to that, order blocks, mitigation blocks, breaker blocks, you will see every time you learn those or you study those, people telling you, oh, but they're not valid without having a fair value gap, or they are higher probability if they have a fair value gap. And it's not me taking a shot at those other people, but if you look into it, then what is relevant? The order block or the fair value gap? Well, if we take away the fair value gap, the order block is not relevant. If we leave the fair value gap and the order block is not there, the fair value gap is still relevant. So what is the superior PD rate? The fair value gap. So everything leads back to the fair value gap. Where even right here, once we come into this 4-hour fair value gap, that's your power of 3. At that moment, most likely we have some form of SMT. We have everything already incorporated into our trading plan when we use fair value gaps. Now, you don't have to believe me on this. Rather, I would not even want you to believe me. But if you want to see this for yourself and if you want to prove me wrong, then you can study the charts and you will get to the same conclusion as I have. So hopefully together we can open some eyes in the trading community that it doesn't have to be this complicated. Again, how complex something is and how simple something is subjective. So that's why I like to define things. But for me right here, using fair value gaps as my main strategy is simplicity. Now, if you find fair value gaps interesting, then I would highly advise watching another video. For example, the previous video of the 1 candle tells you everything. Because in every concept, almost every concept that I use, fair value gaps are incorporated. They are at the core of my strategy. And when you study that 1 candle video, then even this video will make a lot more sense as well. All right, perfect. Thank you.